Hello, everybody. Welcome to today's webinar on forecasting revenue. We have so many things that we're going to be covering today, and it is honestly one of my favorite topics. So valuable for any finance and accounting professional. And we got a lot of really great stuff to cover. We're going to give it about a minute or two for everyone to trickle in. In the meanwhile, definitely let us know in the chat. Who are you? What's your title? And where you are calling from, or where you are dialing in. I guess I sound like a radio station. Where you are joining us from on today's webinar. Hey, Todd, welcome. So I'm going to do this. Josh, I'm fractional CFO, and I am from New York, like David K. Radek, good to see you. I'm glad. I know you had some technical difficulties getting out of here, so I'm glad that worked out. And I'm good to see you at another one of our sessions. All right, we got people from North Carolina, we got people from South Africa and South Carolina as well, so representing both of the Carolinas. I'm curious, how many people here have actually generated a revenue forecast? We don't have any polls set up today, but while you're at it, let us know in the chat. Have you ever generated a revenue forecast? Have you ever created one from scratch or from a template? I'm curious everyone's experience here, because that'll, of course, shape a lot on the content and what we talk about. Now, I can promise, okay, we're having a bunch of people who have, I can promise you that regardless of whether you have or you have not, you are going to learn new things about forecasting revenue, because there's so much to creating a revenue forecast. I have never seen, as we'll soon see in today's session, I've never seen two revenue forecasts exactly identical, even after fractional CFOs of building literally hundreds of financial models in my career. I never was able to say, oh, I built this same revenue forecast for someone else, so let me just go ahead and copy that to the next. So because every business has a different revenue forecast, I think every professional has a different way of creating that revenue forecast. And like I said, given my experience in creating these revenue forecasts, I have to say, in another piece of content that I once created, there were the 4 stages of building a forecast. There was stage 1, which I like to call just building the revenue forecast. And the reason why that's stage 1, you're of course leaving a lot of things off the table, but it's still a very powerful tool because you are translating the CEO, leadership, the investors, the board directors, you are translating their vision into numbers. And it's for that reason that I think this is probably one of the most valuable skills, especially for those who work in strategic finance. Because you're not only translating the vision, which in many times, especially in the early stage for a startup who's raising capital, that's the number one thing that investors want to see, right? If I give you money, what are you going to do with it? How are you going to grow your actual business? But on top of that, when it comes to revenue forecasting, you get the unique opportunity to work directly with leadership. Now, in my career, at least, I can say that a lot of the CEOs that I've worked with were incredibly impressive. CEOs who have run many other companies in the past with successful exits, CEOs with really well-connected networks who made amazing introductions for me, which ultimately helped me scale my accounting firm and grow in my career. And there's no real playbook for forecasting revenue. Well, I've done my best to create the playbook after all of these experiences, and I'm extra excited in today's session to walk you through all of that. Because the truth is, there is a lot of complexity when it comes to forecasting. That's called the 4th statement in creating a financial model. You've heard of 3-statement financial modeling. The first statement being the profit and loss, the second statement being the balance sheet, the third statement being the statement of cash flows. That still is the foundation to creating a financial model. But the best financial models actually have a 4th statement. And that 4th statement is all about the details behind your customers. How many customers are you currently working with? How many customers are warm in your pipeline? What is the average retention for those customers? The average sales price, the average contract value? All of these metrics are not things that you can find directly in your financial statements. So in order to forecast revenue, you not only need to understand accounting well, you not only need to understand strategic finance well, you really need to understand industries, business models, and the ability to work with leadership to translate that information into a beautiful forecast. Now, the good news is with today's session, we're not only going to be going over the theory, But in addition to that, we're also going to be looking directly in Excel with a number of different frameworks that I've created to help you forecast out any business model. Because the idea for me is that after today's session, I don't want to teach you this is how you use a specific template. And if you take this template and you type in this number, this is how you can reuse that. Because like we spoke about, every business model is different. I want to empower each and every single one of you to think about revenue forecasting from a whole new lens. And I want you to use two of the specific frameworks that I've created to allow you to take that information and apply it to any business model, whether it is a $1 million company, a $100 million company, whether it is a SaaS company versus e-commerce versus professional services. All of these principles and frameworks can be applied to any of those business models. Now, in terms of the agenda for today, we're going to do a little bit of a refresher. This is a senior group of people here, so I'm not going to be going over the details on everything with Accounting 101, but I will be going over the difference behind a lot of definitions that I've seen people make mistakes on and get tripped up on, because the terminology will be very important, not only for you, but the stakeholders that you'll be working with directly to make sure that they understand what's actually happening in the business and that they're speaking the same language. We're going to be talking about the two frameworks that I've created in my experience to allow you to forecast out those business models and the additional metrics that you can utilize in order to forecast out that fourth statement like we spoke about outside of those financial statements. Now, when we get to that point, you'll have ideally a centralized location with the templates that I'm using where you can tweak information, you can add and subtract different details, you can make some slight customizations to the business models, but the core frameworks will be in place so that, like I spoke about, you can use that across any business model. And we're going to be talking about the financial statements, the P&L and the balance sheet, and which of those areas are affected specifically by revenue forecasting. We're going to be talking about those customer metrics. Specifically, we'll go a little bit deeper on SaaS today and how the non-GAAP metrics can affect your actual financial statements and financial reporting. And we'll help you get to the point where you feel that you can defend any forecast, whether that's with an investor, the board of directors, or leadership. Because if you've ever been part of any of my webinars or seen any of my content, you know that creating a forecast is maybe just 20% of the way there. That remaining 80% involves you every single month analyzing what actually took place, measuring that against what you thought what took place, analyzing what are the assumptions that need to be adjusted, and learning how to communicate that to the right people. And revenue, that's probably one of the biggest parts about the business. So for those of you who are not familiar with me and my content, it is great to be connected. First and foremost, I graduated, like maybe some of you out there, with a degree in accounting. I got my master's in accounting and my CPA. And I have also been fortunate enough to be a part of the Microsoft MVP community that you may be able to see that little trophy over there. It has been an incredible opportunity blending my experience and skill set as an accountant, as a CPA, with also my passion and love for Excel, connecting directly with Microsoft CM and a bunch of other Excel MVPs. Similarly, I started my fractional CFO firm. June 1st was our 7-year anniversary. And we've been fortunate enough to work with over 100 companies throughout our journey. We have an amazing team in place, and we love working with fast-growing companies to help them focus on the bigger picture of growing their company while we focus on the back end, the operational work, the month-end close, and my personal favorite, the strategic finance, helping translate that into the vision of the future and blending that with what's happening in the actual company. Now, in addition to that, about, I want to say 3 years ago, it may even be 4 at this time, I believe it was 2022, so I think it was 4 years ago, I published my very first piece of content, having no idea what would become of it. I thought this was just a way to tell more people about my fractional CFO agency. In reality, it took on a life of its own, and I'm proud to have an audience on LinkedIn of almost 500,000 professionals, on our YouTube channel. We're just about to cross 75,000, and a number of other channels. For those of you who are familiar with my newsletter as well, I really put my heart and soul into those newsletters. So thank you so much for being here and following along on the journey. Now, the last thing that I will share is, again, a unique angle that I have is I've been building an FP&A tool allowing you to connect directly to your accounting software and build world-class financial models directly in Excel as if it was built with the CFO, no proprietary formulas that'll break or anything like that with our tool Model Wiz. And that's given me a new perspective after working with dozens and dozens of practitioners to build out their financial model and apply that automation engine to it. It's given me an even deeper perspective on building the tools to allow us to get to a robust framework, to get to that robust forecast, and seeing how all these other industries and all these other professionals like to have their financial model set up. Now, although it'll be just me presenting in today's session, I'm incredibly grateful to be working with today's webinar partner and sponsor, Maxio. Maxio is an incredible tool allowing you to streamline your billing and your financial reporting with a number of other SaaS metrics that apply to B2B SaaS industry as a whole. And I personally have been a Maxio user for a number of years now, and I love it when I start working with a company who already is a Maxio user, because the way they streamline all the metrics and calculations, whether it's deferred revenue, whether it's all those SaaS metrics or the invoicing and billing, all that information is so simple in their platform. It makes our job as fractional CFO. I will share a little bit more about our sponsor, but first, let's dive into today's topic. Because revenue forecasting, again, I want to highlight just how valuable it is when you understand how to translate most of the time a CEO's vision into most of the time a spreadsheet. That spreadsheet not only empowers leadership, the CEO, the management team, the board of directors, it not only empowers them to better run their business and understand what are the levers that they can pull in order to achieve what other objectives they're ultimately trying to achieve. It also helps companies communicate that vision to investors in order to secure additional capital, or to the board of directors after they've secured that capital, helping this board understand how safe exactly is their investment? What exactly does the future look like? Are we hitting these targets, or are we off of those targets? Now, what I also love about forecasting revenue is it really gives you the opportunity to blend your experience not only as a finance and accounting professional, but when you work directly with someone and translate what they want into a document, when now you're an engineer, right? Now you're building something that didn't exist, that you are customizing, that you are making come to life. You're also utilizing your sales skills, right? You know how to ask those right questions to the stakeholders and take that information and translate it into something that they feel comfortable standing behind. And this, to me, this is like one of the most valuable things that you can do, because closing out the books, doing bookkeeping, processing AP or invoicing, these are all things that oftentimes a junior level, entry level accountant or finance and accounting professional can handle. But the real value, the riches is in becoming an expert. And this, to me, is one of the highest forms of expertise, being able to translate that vision into a full three-statement model. So let's kick off with just some definitions, because I hear this all the time and I really want to avoid any possible confusions. First, there is a booking. Then there is a sale. And finally, there is revenue. A booking, to me, again, these are distinct terms. And while you may hear people say, use them interchangeably, a booking is a commitment to a sale. Now, that booking may be a $3 million booking that involves $1 million of invoices sent every single year. $3 million booking. The sale, to me, is what gets backed up by an actual invoice sent. So if you send out an invoice for $1 million, which means you have a great business model, that to me is a sale, different from an actual booking. Now, neither of these over here are GAAP metrics. Technically, a sale is going to affect your financial statements. A booking could have nothing to do with your financial statements if an invoice is not generated yet. Revenue over here is the most relevant now for your three financial statements, because this is when you actually earn out the sale that you generated. When you then send out that invoice under accrual accounting, you can't recognize all that information directly. Instead, you'll recognize that proportionally to what you actually delivered directly to your customer. And like we spoke about, even though every single model is like a snowflake, like I spoke about, where no two are the same frameworks can apply to being able to forecast all three of these metrics and tie them together. Now, we're going to be talking a little bit later about how to do all this in Excel, but I want to give everyone just a little bit of a preview of some dangers that you may find. And this is something that happens all the time with the clients that we work with. It's one thing to forecast revenue, but like we spoke about, if you're not actualizing your model, if you're not analyzing the potential variances on that model, you're really only 20% of the way there. And in order to properly book your revenue, in order to properly reconcile that information and compare against what you thought was going to happen, most of the time, companies start off doing that entirely in Excel. Now, I will always sing my praises about Excel, right? I'm a Microsoft MVP. It's our tools and Excel tool. I love Excel, but I also recognize when it's not powerful enough for what you're ultimately trying to do. And usually that breaking point is at the 40 or 50 contracts mark. Usually when you're at 40 or 50 contracts, you get to the point where it becomes very challenging managing each and every single contract directly in Excel. Because oftentimes, not only does one entry affect revenue, deferred revenue, unearned revenue, accounts receivable, and other items, in addition to that, you have all of your non-GAAP metrics, which it could potentially impact, like your ARR, your net dollar retention, and on and on. And similarly, a lot of times what I see happen is a company has to go back and make a retroactive adjustment. And that retroactive adjustment is so painful because now you're restating all these different things and you have these disjointed systems that make it very challenging to have everything streamlined. So I want you all to keep that in mind, regardless of where you are in your journey. Maybe you're an advanced company that is still using Excel. Maybe you're an early stage company that's outgrowing Excel. Keep in mind that there is a breaking point, but for today's session, we're primarily going to be doing everything in Excel so that you can master these fundamentals. Now, we're going to be talking about two different frameworks in today's session. The first framework that we're going to be talking about is what I like to call the revenue sources framework. E, P, and N is our acronym. I'll walk through what exactly that acronym means in just a second. The second framework allows you to forecast any business model, and that involves the acronym ARSR, what I like to call the revenue growth framework. And using these two frameworks together, the idea is that any business model, you'll be able to forecast accordingly. We'll then go over the third pillar, and that's all the non-GAAP metrics that are going to be affected specifically by your revenue forecast. And we have two templates, one that showcases both of these pillars, both of these frameworks in pillar 2. And then we have another one that showcases all of these SaaS metrics and how to think about that in your business. So let's get started, right? Let's say that you have a $12,000 booking, right? Well, remember, under accrual accounting, we spoke about the fact that that is not only going to affect one line item on your financial statements, it's going to affect your balance sheet, and it's going to affect your statement of cash flows and your income statement. It's really going to affect all three of those financial statements via this special account called deferred revenue. Now, deferred revenue is one of the most popular areas specifically for SaaS, but it could really apply to any business. And as you all know, it represents the unearned amount from any contract that was actually generated or an invoice actually sent. Now, the way that I want you all to think about this second pillar, the two frameworks, is when you're forecasting revenue, here's a mistake that I made in my career that I want you guys all to avoid. I remember it was one of my very first times putting together information for a board meeting. And I worked day and night with this client to come up with all these sophisticated ways to show to investors how exactly we're going to be generating sales for the company. And I wasn't allowed in the board meeting because I was still too junior in my career. And I remember eagerly waiting after the board meeting to hear how did it go? Did the CEO feel well supported, or did I blow something up and make him look like a fool? When I followed up with him and I asked how the board meeting went, he said, the investors liked the first part. They liked seeing how we're going to generate new sales. Then I got one question and everything crumbled. And that was, where are your renewals? Because the truth is, majority of businesses out there have repeat purchases, have renewals on contracts. And if you're missing that, you're missing a crucial part of your revenue forecast. And ever since then, I've come up with this acronym to allow me to solidify 3 different sources that it's going to affect your revenue. And like I mentioned, it's EPN. The first is understanding how are you going to be forecasting revenue from your existing customers? How will you be recognizing revenue from the customers who are warm in your pipeline, a CRM like HubSpot or Salesforce or Pipedrive? And then finally, these new customers, right? What is your business model? And my mistake was I really only focused on the new business model part. I didn't talk about anything related to their existing customers. I didn't talk about those warm deals, given the fact that many companies have a long 90-day deal cycle, which makes sense to then layer in this pipeline for at least the first 3 months of projections. And I don't want you all to make that same mistake. I want you to really think about a business as 3 separate cohorts that all get joined together. And rather than me just talking about it, why don't we all go through that information in Excel? Will, if you wouldn't mind just enabling the handout called revenue forecasting, I'm going to switch my screen and we're going to go over how exactly that all works in process. So just give me 1 sec. And there's a handouts button at the very top of the chat. When you click that, you should be able to access the Excel file. If you are having any issues, just let us know in the chat and we'll be able to help you. Alrighty. I'm assuming everyone here can see my screen. I can see it over here, so we're all good. So this is what I want to walk you guys all through, right? This is what a mature revenue forecast looks like, allowing us to understand our billings and our revenue by all of these cohorts: existing customers, pipeline customers, and new customers. So let me show you how this works. Let's start with our existing. The idea with your existing customers is, for any of you who have joined any of my other sessions, you know that I'm a very big believer in structuring my Excel files in a way where whatever source documents I need to export from a database, from a separate platform, from an accounting platform, a CRM, I like to always export it in its native format. So for my existing customers, maybe this comes directly from my accounting software, or maybe this comes directly from my CRM. Now, once again, I just want to remind you, if you can't find the handout on the top where it says chat, you just click on handouts and then you'll be able to see the file. Will, maybe you can help in the chat for those people who are still struggling. Now, I'm hearing that the Excel is not very clear, so hopefully you guys can see this well now that I just zoomed in a bit. So the idea, okay, it looks like the handout also just popped up, so you guys can go ahead and grab that over there. The idea is that this is showcasing to me all the companies that I'm working with, the invoicing cadence, the amount, and finally, the actual invoicing date. So what I like to do is, for you, it may look a little different. Maybe the table is structured a little bit differently. Maybe you have some extra columns or you have columns rearranged. What I like to do is take this information and tie it to a formula. So what this formula does is it allows me to understand which of my invoices are coming due for renewal for the very first time, or rather for the first time from what I already exported. So in this case, I'm showcasing that I have $6,000 in monthly invoices that I am forecasting into my model. If we go back to the existing, if I filter on monthly, you can see that this amount over here, oops, this 6,000 right over here, is what we're showing in February. So my formula, I'm not going to go into crazy detail on it because I don't want to get stuck on an Excel formula syntax, but what my formula is doing is it's bringing in the invoice amount if the billing period is equal to monthly, and if the invoicing date falls within this range that I am in right now. This allows me then to bring in all of the values that you see over here. And then all I'm doing is taking that renewal and assuming that each contract is going to renew. Now, we'll talk about churn in just a second, but what's powerful about this is now every single month, I can just refresh this table. And this table will allow me then to populate this tab over here, showcasing how much I'm billing across all of these different platforms over here, all these different cadences. So for quarterly, I'm taking 3 months prior. For annual renewals, I'm taking 12 months prior. I now have a source of truth that comes from my CRM, my accounting platform, whatever I need, and the formulas are set up so all I need to do is refresh that information. Now, like we spoke about, revenue is not the same as billings. Well, it may be the same if you have a monthly contract, but for quarterly contracts, that's completely different, right? We need to now take this amount here and divide it by 3. For annual contracts, we need to do that same thing, but this time take the cohort amount for the billing and divide it by 12. There's a lot of really great information in this file. Again, I'm not going to go into the details of how I built this waterfall because that's an entirely separate webinar that we can have over here. But I really want you guys to understand the idea that we have billings. These are billings that all come from our existing customers tied to this table. We forecast out the initial renewal and then all subsequent renewals. And then we plug in those totals to get to our revenue via these waterfalls. Now, like we spoke about, back to that EPN framework. What does that stand for? Existing customers, pipeline customers, and new customers. We just talked about the first third. Just this alone, most likely, you'll be 80% of the way there for the first month of projections. Depending on how fast the company is actually growing, most of the time you're not growing by more than 10%. So you can definitely, very reasonably be within 10% accuracy if you just set up a system like this. And when leadership or an investor says, where did you get this number from? Now you have proof. Now you have evidence. You can back it up directly via a table like this. So if you guys just want to let me know if this is all making sense, tell me in the chat, maybe give me a thumbs up. Say sounds good. You're welcome to also ask any questions, though we will concentrate the bulk of our questions for the very end. And while I'm waiting on that response, I want to talk about the second part in the EPN framework, and that is the pipeline over here. And like we spoke about, a pipeline comes from a CRM, and they reflect warm leads, who you're in touch with, who you've been engaging with, who you've had multiple meetings with, who maybe told you, hey, it's sent over to legal, hey, we're about to sign, just give us a few more days. This is probably one of the highest levels of accuracy for the early stages of your projections for where exactly your sales are going to come from. And you'll notice that all the information is very similar to what we just showed, with a few differences. First, we have that same deal name, we have that same length, we have the same date. In this case, it's when the deal is going to close rather than when it's going to renew or the last invoice date. We have the amount, right? All that's the same, but now we have some differences. First, we have a deal stage, and that's what a CRM is all about, right? These deals, who I've been in touch with, well, this person said, let's book a second follow-up call. This person said, I need more time. This person said, I'm not interested. This person said, we're moving forward. All of these deals over here translate into a close likelihood. They help us apply a weighted average to our pipeline, which now adds credibility. We're not going to tell investors, hey, we're going to close all these deals, because the truth is some will close and some won't. So instead, we take this weighted pipeline via this close likelihood column that you see over here. Now, this closed likelihood column, the good news is you can create a separate table like I have over here. And this separate table allows me to assign a closed likelihood for each and every single stage. So if it's that data are imported, I'm going to say 25%. If it's process and value alignment, I'm going to say 50%. You may have different stages in your company. You may put different percentages. The key is to apply this information first via a direct export from your CRM, then to apply that weighted average to get to this column that you see over here. Because this is now the column that we care for, right? This weighted average column is going to be what we bring into our forecast. I don't want to bring in this gross amount. In this case, the person was closed loss. I don't want to bring in anything related to it. Well, that's what this weighted average does. It takes the closed likelihood and multiplies it by the amount. So if we want to now generate this tab, which again connects to that pipeline tab, we have the same way of doing that, right? All we need to do is take this information, analyze which one of our contracts are monthly for the length, and the close date falls within this period. Let's pull in the weighted average when that happens, and then again, we're going to forecast out all those renewals in the same way. Quarterly is 3 months later, annually is 12 months later. Just like last time, right? We have our billings up here, we have our revenue down here. All that information can now flow through into this revenue summary. This is how much we have in existing, this is how much we have in pipeline, and the same thing for revenue. Now, we mentioned before that you may be 80 to 90% of the way there with your forecast if you just include your existing customers via that existing tab. Especially for B2B businesses where you don't close someone right away, it most likely takes 30 to 90 days. This gets you close to 100% of the way there for the first 1 to 3 months of projections. And still, even after that, the majority of projections are all coming from here. So if you figure out a way just to blend in these two imports, which again may look differently for your company, into an Excel sheet where all you're doing is refreshing this table and your formulas stay up to date, well, now you're 95% of the way there, depending on the month that you're in. The last part comes down to how we're going to forecast out revenue from our new customers. Because most of the time, you're not going to be creating a forecast just for the next 3 months. You'll be doing the next 12 months, the next 24 months. Maybe it's a long-range forecast where you want to show the next 5 years. You can't just rely on your pipeline because maybe those conversations haven't yet been heard. But instead, you need to be able to create a mechanism where you can showcase defensively how your business model translates into a spreadsheet and how you're going to generate sales in a repeatable fashion. And again, if you have no existing customers, if you have no customers in your pipeline, and if you're trying to raise capital, this new tab is pretty much going to be 100% of your forecast. And if you can show this blueprint, if you can show investors that you really understand how this works, well, now you get the opportunity to really translate that vision in a defensible way. And in order to do that, we have to talk about our second framework for forecasting revenue. We already talked about the first framework, and that was EPN for existing, pipeline, and new. The second one is building a bottoms-up forecast where the right inputs result in the right outputs. And it is not just done by entering in random values in a spreadsheet. It is done methodically so that when people say, prove to me that you're going to be tripling next year, you show them the assumptions and you say, here they are. Tell me what you have an issue with. I'll be able to defend it based off my conversations with leadership, based off my conversations with the sales department, and on and on. And the acronym for forecasting revenue under this second method is ARSR. And like I spoke about, any business model, if you think about these 4 letters, you'll be able to translate this into a defensible revenue forecast. The A stands for acquire. We're going to go over all this in Excel in our second Excel sheet in just a sec. Well, that's actually the first Excel sheet. The second one is going to come later. The A stands for acquire, where we ask ourselves, how are we going to acquire users? Do we have a sales team? Are we going to put ad spend? Are we going to focus on partners or referrals or conferences? Once we acquire those customers, how long are they going to stay with us? Will they buy once, like an e-commerce business? Maybe there's a repurchase rate. Will they buy every single month on a monthly contract? Will they buy once a year on an annual contract? These are all questions that are up to you to find out from the business. Once we find out the length, the duration, how often we're invoicing them, we now need to understand, well, what exactly are we selling? What products do we have? What's the product mix for each type of customer? Maybe we're creating different cohorts for different types of customers. And then finally, your revenue forecast, like we spoke about earlier, it doesn't just affect your revenue. We already spoke about deferred revenue. There are other areas it can affect as well, like your COGS, like your accounts receivable, like maybe your inventory. The list goes on and on. As a strong finance and accounting professional, it's up to you to understand that full picture from your conversations with leadership as you understand the business model. So why don't we now go over that second tab over here. And Kyle, I see, has a good question. Let me just cover that quickly. How do you easily translate forecasts and bookings into renewals 1 year following the booking date? Well, why don't I show that really quickly, and then we'll go over the ARSR framework. But to answer your question, Kyle, what I like to do is I like to assume 100% renewals. So in this case, I'm just taking the prior month. In this case, I'm taking the prior quarter. In this case, I'm taking the prior year, right? Because they're monthly, quarterly, and annual deals. Maybe your business just has one of those. Later on, we're going to be going over how to layer in churn, because churn is something that I like to do at the cohort level. And that is a relevant discussion that we'll talk about. Thank you for your question, and looking forward to answering more at the Q&A portion. All right, let's go over how to now forecast revenue for any business model using this ARSR framework. Now, there's a lot of information here. I do have a separate YouTube video if you want to go into depth. I even have a separate course if you really, really want to go into depth. But honestly, the bulk of the course I'm teaching you all right now on this webinar. I can't go too deep, though, but I'm hoping that you guys cover and understand the majority of this. I like to always have my assumptions up top. These assumptions are in blue. And like we spoke about, the first part of the ARSR framework is understanding what are our sales channels. Now, every company has different sales channels. What's applicable to one may not be applicable to another, but I've generally found these 4 sales channels cover the majority of the actual acquisition channels that you may have. And especially when you're in B2B sales reps is probably going to be the most common. You have a call with someone, you do a demo, you send out a proposal. That is what really we just covered with the CRM, right? Well, each of these over here, before I expand and show you how to get to that build-up, that again, I'm just going to scratch the surface on, I want you to remember what I spoke about earlier. We're building a defensible forecast. That doesn't mean that we just say this sales rep is going to bring in 3 deals, that sales rep is going to bring in 5 deals. We need a defensible way in which inputs will translate into outputs. So for sales reps, there are a number of things to think about, right? When you hire a sales rep, the person's not going to be able right from day one to hit that quota. You're going to tell that sales rep, I need you to bring me $100,000 in bookings every quarter or every year. And you're going to tell that person, while I want you to hit that, I recognize that there's going to be a ramp-up period, right? You need to warm up these contacts. You need to start having these conversations. I can't expect you to hit this full quota right from day one. Well, now we have some inputs that we can actually apply. We can understand what is the ramp period from when they first join our company. How many customers are we giving them as part of their quota? And what is the utilization? Because most likely across your entire sales team, they won't be 100% hitting quota. The most common number is 80%. And that gets us to our net quota. So if we take one sales rep, remember, we can't just assign that one sales rep. This is saying 24 customers a year, or rather each sales rep should bring in 2 customers a month. Remember, when the sales rep first joins, we need to have a ramp schedule, right? For them to get to know our company, to get to know our prospects. And that ramp schedule, according to this, may take 5 months from when they actually join. Well, that's where this other waterfall comes in, right? One person joins. They are 30% ramped in month 1, 50% ramped, 70% ramped, 85%, and then finally 1. I can change this to 45%, and now the actual ramp period adjusts. The idea then is if I know that I have a sales rep at 45% utilization from this ramp, I could just multiply these 2. Now, I understand this is a lot, so I don't want to bog down and go over so many crazy details and overwhelm you here. I just want you to think about this channel. A sales rep gets a quota. That quota gets translated based off of a utilization and based off of when they first join over a ramp period. The more sales reps, the more sales based off of these inputs. If an investor has a problem with how did you get to a new customer starting only in the 2nd month they joined, well, you can walk them through these assumptions, and now it's defensible. So I'm just going to talk about at a very high level now how exactly these other channels work, because it's the same thing. You need to ask yourself, what is the input, i.e. the cost? What are the assumptions based off of those inputs? How can that reasonably translate into a new customer? Remember, we're just talking about acquisition. So for digital marketing, right, what are some of the inputs for digital marketing? Well, how about how much money are we spending on ads? What is the cost per click? What is the conversion to demo or to paid sales, right? You can schedule all that. If I spend $20,000, maybe the cost per lead is $80, which gets me 250 leads in this month. Maybe then there is a 5% conversion, which means that we're getting 13 new customers in this month from $20,000. It doesn't matter what these inputs are. It doesn't matter what these assumptions are. What matters is you're thinking about that equation so you can defend each and every single metric. Now, we have another question over here, please. For context and perspective, the data used is for what industry? The beauty of this framework is it doesn't matter what industry that you're in. Some industries have a higher weighting or have more applicable channels than others. So for example, in an e-commerce business, digital marketing is probably the most common sales channel, right? You're putting paid ads, Google ads, Meta ads, people are coming to your Shopify store and they're purchasing. For enterprise sales, you're dealing with sales reps. For B2B, you're dealing with sales reps. It really depends on the industry, but the general idea is that all industries, most of the time, have some form of all four of these channels. So I'm not going to go over all the other details. These are just another way where with partnerships we can get to information, or organic we can get to additional information. The idea is that once you now have a total amount of users, which I'm really just summing from this first part of the ARSR framework, right? We've acquired our users. What now happens to those users? Well, when we sum, we know that 17 of our customers are going to be acquired. This area tells us which product each customer will purchase if you have multiple customers, multiple product type, and what is the cost per that product. So remember, we talked about retaining, right? Well, this over here gets us to the total users by product. And now we can understand our initial bookings by multiplying each of these products by the cost. So now we have the sales aspect. And in this case, we're assuming that everyone renews 12 months later. So the retention is 12 months. The sales is being defined above. And then once again, we're recording all the additional information. Our revenue, our cost of goods sold, which once again, that revenue, if I divide this number by 12, you can see this waterfall amortizing all of it. Now you can take all that information and we can roll it up, right? We can see the full picture. We can understand how much we're billing from our existing customers, how much we're billing from our pipeline customers, how much we're projecting to bill from new customers. We can understand the corresponding revenue impact. And in order to get to deferred revenue, we have a simple calculation taking our opening balance plus the amounts we bill minus the amounts that we subtract. So once again, there's a lot here. I'm not expecting you guys all to be pros with everything on how this actual spreadsheet is set up, but I want you to understand the underlying concept. We spoke about existing and pipeline customers. Now we're talking about new customers. The ARSR framework helps us understand how are we going to acquire those customers? What are the channels and inputs to get us to customers? How long will we retain those customers? In this case, it's a 12-month retention. And then we renew. And finally, how do we sell to those customers? What products do they buy? And what other areas of their financial statements are affected? Now we have a really robust way of putting together our very first revenue forecast. There was a great question earlier that I want to get to that relates to churn, right? We can't assume that everyone is going to renew. And on top of that, there's so many other metrics that we didn't really talk about. Specifically in a software business, there's MRR and ARR, which is a non-GAAP metric. There is customer acquisition cost. There's net dollar retention. Let's talk a little bit about that before we then get into Q&A. Let me switch my screen and talk a little bit about those other metrics. Because now we're starting to introduce, technically we already introduced the fourth statement with that pipeline and existing customer import, but now we're starting to introduce non-GAAP metrics, which becomes challenging because in reality, these non-GAAP metrics, you'll have to have a lot more information outside of what you find on the income statement and balance sheet. And the most common non-GAAP metrics are MRR and ARR, specifically for SaaS businesses that we're talking about. That represents the amount of recurring revenue, either on a monthly or an annual contract basis. There's your customer acquisition cost. That customer acquisition cost represents how much it costs for you to actually acquire a customer. There's your lifetime value, the total amount that you could expect to have with that customer over time. There is the CAC payback, allowing you to understand how long it takes for you to get a payback from the amounts that you invested with that customer. And finally, there's the net retention, allowing you to understand when the contract is over, how much did you retain in that actual contract value. So we're going to hop now to the second Excel file to go over how exactly, once you have some of these metrics, you can forecast that information correctly. Now that file is called Maxio SaaS Metrics. You can find it in the same place from before, and you'll also notice that now we have a pop-up. Thank you for that, Will. Now, I'm not going to go over all the details. I want to spend just 5 minutes talking and wrapping this stuff up so that we have enough time to go over questions. But the idea is that the most important metric, oftentimes for a SaaS business, is going to be ARR, annual recurring revenue, and MRR. And instead of just recording the amounts all in, you want to think about how did the amount start? What was our opening balance? How much did we add in new recurring revenue? How much did we lose customers who opted out entirely? How much was expanded by customers who are still with us and increased their contract value, or vice versa? They're still with us and they decreased their contract value. This gets us to our ARR, and if you divide it by 12, you get to your MRR. For logos, that's another important thing that we want to ask. How many logos did we start with? How many did we add? And how many did we lose? The idea is that with this template, as long as you enter in all of the values in blue, which are the ones up top, the ones below here, everything else should populate. We have some values pulling from the profit and loss as well. Those are the items in purple. I'm not going to be going over all the details on this. I actually do have a YouTube video coming up shortly that'll walk through all of this. But this should give you a really strong mechanism for forecasting out any software as a service business, which to me is my favorite business model. So let's now just wrap up with a few remaining points. Like I spoke about earlier, a lot of this information is manageable directly in Excel when you're a small company. But the truth is, there are a lot of challenges, even for small companies, in ensuring that all of the actual metrics are tied together, they're speaking to one another, there are no variances between one or another, and that's oftentimes one of the biggest challenges of working with Excel. You don't get that direct integration, you don't get that automation. Even if you're using something like Power Query, it becomes fairly challenging. And on top of that, like I spoke about, usually all the work that you're doing in Excel, you're doing by hand, and a lot of times when you get to about 50 or 60 contracts, it becomes totally not feasible. If you're a fractional CFO and you're working with a client, I suggest a very strong pushback or a much higher premium that you would charge if they're still working directly in Excel. But on top of that, I will say that there are two paths. You can stay with the Excel path, or you can integrate a system that allows you to streamline and facilitate all of that. And to me, Maxio really is the best system to do that. A huge thanks once again for them sponsoring today's webinar and keeping this free for everyone. I want to remind you guys all, Maxio is really one of the first players in the space, and they really do this best. They help you consolidate all of your billing metrics, all of your SaaS metrics. They allow you to get your order forms out and instantly, with the right automation, have it delivered directly to your customers, synced directly to your general ledger, and they keep everything really streamlined. I'm a huge fan of Maxio and a very proud sponsor. And once again, I'm a very big fan and appreciate them sponsoring. So we spoke about a number of different items that affect your revenue over here and the different areas that could ultimately break if you're staying in Excel. We spoke about a lot of really good things. Before we spend time now going over everything directly in our Q&A, I want to just do a really quick recap. There are a number of different terms that get turned around. To me, a booking is a commitment to buy, usually via a contract. It could represent multiple years. A sale is backed up by an actual invoice, typically a year maximum. And finally, revenue is the amount that you actually earn, specifically under accrual accounting. It could be the amounts that you collect under cash basis accounting. The two frameworks that we can use are EPN for our sources, existing customers, pipeline customers, and new customers, keeping all three of those separate and bringing them together via that first Excel file. For new customers, we follow the revenue growth framework. ARSR, with the A standing for acquisition, the R standing for retention, S standing for sales, and finally the final R standing for recording. When you bring these two together, it becomes a lot easier to then showcase revenue in a defensible manner across all three of these different segments in the EPE framework. And while this is all great working in Excel, I encourage all of you to think about adopting a tool like Maxiel to allow you to streamline all this. With that being said, it is a pleasure sharing all this with you guys. We're now going to cut for the last 10 minutes onto the Q&A. If you haven't shared a question, go ahead and do that. Ryan, I do appreciate the feedback. You mentioned that the mic over here, which this is actually just what I'm using for my headphones, my microphone is actually up top here. It sounds like maybe that wasn't so ideal. I'd be curious to hear from other people if you had difficulty hearing me. I appreciate that feedback, and I'll keep that in mind next time. We're now going to go over the Q&A. Will, am I going to be doing this on my own, or are there items that you collected on your end? I'm also not sure if there are any questions, so we don't have to force it if there are none to go over. Okay, well, it looks like we don't have any questions. So I'll just wait a few minutes in case anyone does have any questions. Otherwise, I'm happy to end here and give you guys all some time back in the day. All right, Lisa, thank you for confirming that there was no trouble with the audio. That's nice to hear. How does the billing roll forward scale up? Well, thank you for that question, Kyle. Let me switch my screen share back to Excel over here. The roll forward, how does it scale up? I'm not sure exactly what you mean by how it scales up, but again, to me, the idea is that I want to create a table showcasing the information directly from my database or CRM containing these fields, right? Who's the company name? What's the billing cadence? What's the contract amount? And when was the last invoice date? To me, this could be a $1 million company. This could be a $100 million company. The idea is, as long as you have a way of refreshing this table, the same structure, different information each month, your data should stay connected directly from this tab. The same thing with your pipeline, right? Your CRM is going to be changing way more frequently. As long as you have a way where you download it in its native form and you copy and paste it or build some sort of integration, maybe with like a Quad cowork, the information then, regardless of how many companies you have, can roll forward. Now, I guess if you have like tens of thousands of rows, maybe your Excel file will get a little bit slow, and that can become a little bit challenging. But I don't really see any challenges with this current method. I hope that answers your question. If not, we have a lot of time, so you're welcome to ask a follow-up. All right, thank you guys. I'm glad that you enjoyed it. Can you go over expansion and contraction again quickly? Yes, I can, and I actually have that separately. I didn't really talk about it too much, so I'm happy to talk about that right now. What I like to do for forecasting churn, expansion, and contraction is to analyze for historical numbers what percentage of my opening ARR went to loss. So if I lost 10,000, I started with 500,000. That means that 2% I lost to churn. 5% I gained in expansion. Again, how much did I expand divided by the opening? I take that same information, and then going forward, I can apply that to the percentages here. So I would just say this times the average of these percentages over here. I can now lock the opening amount, and I could copy this down, and the information will update. So the more historicals you have, the easier it is for you to then forecast out churn, contraction, and expansion in a way that's defensible from what is actually happening. Now, I have this also in the other Excel file. I'll just walk you through really quickly. These are two ways of really doing the same thing. If you go to the Revenue Summary SaaS tab, you're going to see at the very top that we again have these percentages. And the way that I deal with these percentages is I take the opening ARR, I multiply that opening ARR by this assumption over here. So ideally, you're taking the average of the historical assumptions. But for projections, if you also just want to type it in, assuming you could defend this number, then the information is really just a reflection of the percentage based off of the opening values. That's how I actually focus on that. So that would be how we forecast churn while all the other contracts in these tabs renew at 100%. I hope that helps answer your question. All right, let's go over a few other questions that we have. Can you quickly touch upon COGS? Yes. So cost of goods sold, you may be familiar, is the cost to deliver your product or service. Now, delivering your product or service does not reflect the cost to build your product or service. For all of you SaaS people out there, if you're building out your website, adding new features, that is not a cost of goods sold. That is an operating expense. Your cost of goods sold, in order to understand what is a cost of goods sold, you need to ask yourself, if this cost went away in my business, can I still deliver this revenue? If the answer is no, that is most likely a cost of goods sold. So for software, the most common cost of goods sold is going to be hosting, is going to be your domains, is going to be your servers. For all of you guys who are adopting AI, it's going to maybe be your token usage. These are all things that you need in order to deliver the product or service. For an e-commerce business, well, that'll be the actual cost to develop the product itself that you're then selling. If you didn't have those materials, you can't actually deliver that. So the way that you could forecast COGS, well, it really depends on the business model, but you need to ask yourself, how does this cost of goods sold scale? Will it scale based off of a number value for each sale? One sale results in $7 in COGS, like an e-commerce business. Will it maybe be a percentage of revenue, or maybe it has some sort of a cap, or maybe it's a combination? These are all the questions that you need to ask with leadership as you meet with them and build out your revenue forecast. Great question. Thank you for asking that. All right, we got a few other questions. Thank you everyone for the kind words who enjoyed this. The cost of sales customer care should be in gross margin. Well, that's a good point. Customer support oftentimes can be in two separate areas. If it is oftentimes required in order to maintain a relationship, it'll go in your cost of goods sold. There could be some customer support line items that are maybe like supporting prospects or leads that would go in your operating expenses. Similarly, people oftentimes have customer success, which is different from customer support. Again, these are mainly for a SaaS business, and those would also be operating expenses. That's a very good call. A lot of customer support would actually be a cost of goods sold. All right. Gareth asks, would I be able to add in revenues from projects which are based on specific deliverables over the project lifecycle? Challenge that I've had is that these milestone dates are always moving targets. It's a great question, Gareth. What I would challenge you to think about is how exactly is the information for these upcoming projects being tracked? Most likely, you have that information via an accounting platform somewhere, or maybe it's a database, I'm not really sure, but most likely that's being tracked somewhere, wherever that place is, even if it's another Excel sheet. The idea is to take it in its raw form and to get the information into a table where you can then attach your projections to it. So it doesn't matter what format it is, it doesn't matter how often it actually changes, you just need to develop that import-export capability so that each month you're just copying and pasting the same information. I think projects are extra tricky, especially with construction businesses. There's so much to it, but it's a very important metric. That is how I would generally really approach any sort of Excel efficiency. I like to call it the Excel SIP framework. Your sources, which is what you see over here, your inputs, which is what you see over here, and finally, P is for presentation, the actual values that you then get rolled up in a read-only view. So I hope that helps. All right, Josh is asking, curious about how you would adapt this to customer tiers and pricing in SMB and enterprise contracts. Great question, Josh, and that is a very popular part of a revenue forecast. We're going to have to get to maybe just one or so more questions, or this may be the last one. But a revenue forecast, what I like to do is most of the time you have different tiers for customers. What I like to do is I like to forecast out how many new customers I'm going to bring on, regardless of tier. I apply a split and then the average contract value for each of those. So you can see that I'm bringing in all the customers from up top and then separating out those customers by these percentages, and then the sales get brought in by a sum product of these customers at these customer types. I've got one last question over here. Is it best to track new loss, expansion, contraction in your accounting software or your CRM? Well, you actually can't really do that on either of those. A CRM oftentimes will not show you detailed information related to your SaaS metrics. Almost definitely, a traditional accounting software will not as well. That's the whole reason why a tool like Maxio is so valuable. These are non-GAAP metrics, and Maxio allows you to combine all that information. So I hope that helps answer your question. Guys, you've all been great. This has been such a valuable topic. I love talking about these types of things. If we haven't already connected, go ahead, shoot me an email, josh@yourcfoguy.com. You can add me on LinkedIn as well. Just put in the description that you were at today's webinar. Check out my YouTube channel. Again, a lot of really great content there, and we're continuing to pour a lot of resources. Once again, a huge thanks to Maxio as an amazing partner in keeping today's webinar free. I hope you all enjoyed it, and I look forward to seeing you guys all at the next one. Take care, everybody.